You ever open your banking app, stare at your balance for a second, and just feel stuck? Like, not broke exactly, but not really moving forward either. You've got some savings. Maybe a little bit. Maybe more than you used to. And every now and then you think, I should really invest this. You watch a couple of videos, maybe scroll through some posts, and suddenly it feels like everyone else is out there making money while they sleep. Stocks going up, crypto exploding. People casually mentioning 10%, 20%, even 100% returns, like it's just normal, and then you try to figure it out, and it's chaos. Charts, indicators. Buy the dip, sell the rally, watch the Fed. Diversify into emerging markets, and suddenly your brain just kind of shuts down. Because honestly, you don't want a second full-time job just to grow your money. You don't want to spend hours analyzing companies. You don't want to wake up at 3 a.m. checking if some stock dropped 8%. You don't want stress. You just want something that works. Something simple. Something lazy, and yeah, I know how that sounds. Lazy investing doesn't exactly sound like a winning strategy, right? It sounds like cutting corners, like settling for average. But here's the weird part. Some of the people who make the most consistent, long-term money in investing are the ones doing the least, which is honestly kind of frustrating if you think about it. Like, why does the person doing less often end up with more? My name is Tim, and I spend way too much time thinking about money, why people overcomplicate it, why the simplest strategies are often the ones people ignore the most, and this whole lazy investing thing. It kind of flips everything most people believe about building wealth, because it's not about working harder. It's about not getting in your own way. And once you really understand that, it changes how you think about money completely. There's this belief most of us grow up with: if something is important, you should work hard at it. Makes sense, right? You study hard to get good grades. You work hard to get promoted. You grind to improve your skills. So naturally, when it comes to investing, we assume the same rule applies. More effort equals more reward. But investing doesn't really follow that rule, in fact. It almost punishes it. I remember the first time I realized this sit was kind of uncomfortable. I had a friend, let's call him Ali, who got really into trading. Like, seriously into it. He had multiple screens, charts open all the time, notifications on his phone, constant updates. He knew earnings reports, economic data, all of it. He worked hard. Meanwhile, another guy, a new completely different approach. He'd just put money into a couple of broad funds every month and didn't really think about it. DN check daily. Didn't react to news. Didn't try to time anything. Guess who ended up doing better over time? Yeah, the second guy. And it wasn't even close. Because the more Ali tried to optimize everything, the more mistakes he made. Overtrading. Reacting emotionally. Second-guessing himself, and the other guy, he just stayed out of his own way. That's when it kind of clicked for me. Effort in investing doesn't always translate to results. Sometimes it just creates noise. Okay, so when we say lazy investing, we're not talking about being careless. We're not talking about throwing money randomly into things and hoping for the best. It's not laziness in the sense of neglect. It's laziness in the sense of intentional simplicity. It's choosing a strategy that doesn't require constant attention, that doesn't rely on predictions, that doesn't depend on you being smarter than everyone else in the market. Because here's the uncomfortable truth. You probably aren't, and neither am I, and neither are most professional investors. By the way, so instead of trying to beat the system, lazy investing just joins it. It says, you know what? I'm going to own a piece of everything and let time do the work. That's it. No guessing which company will win. No trying to time the perfect entry. Just consistent. Boring participation, and yeah. It sounds underwhelming, but boring is kind of the point. Let's talk about the core of this strategy. Index funds. If you've heard the term and kind of nodded along without really understanding it, don't worry. You're not alone. Basically, an index fund is just a collection of stocks bundled together instead of buying one company. You're buying hundreds or even thousands at once. For example, imagine owning a tiny piece of every major company in the market, big tech. Healthcare, banks, consumer brands, all of it. If one company fails, doesn't matter much. If others grow, you benefit. It's like spreading your bets across the entire economy instead of trying to pick one winner. And historically, that's worked incredibly well because economies tend to grow over time, not smoothly, not predictably, but consistently in the long run. So instead of trying to outsmart the market, you just ride it. Here's the part people don't like too. Admit most investing failures aren't about bad picks. They're about bad behavior. Buying when things feel safe, usually at the top. Selling when things feel scary, usually at the bottom. Chasing trends. Panic. Selling overconfidence. It's emotional, and the more involved you are, the more chances you have to mess it up. Lazy investing reduces those opportunities. It removes the constant decision-making. It creates distance between you and your impulses, which is honestly one of its biggest advantages. This is where things get tricky, because the lazy strategy depends on time, and time is boring at first. You invest a little, nothing happens. Another month, still nothing. A year goes by and you're like, is this even working? It feels slow because the early stages don't look impressive. But compounding doesn't show off in the beginning. It builds quietly. Then suddenly it doesn't. It accelerates. And the people who stick with it, the ones who don't interrupt the process, are the ones who benefit the most. Let's say you invest a small amount every month. Nothing crazy, just consistent. At first, your growth comes mostly from what you put in. But over time, your investments start generating returns. And those returns start generating their own returns. That's compounding. It's like a snowball. At the top of the hill, it's small, easy to ignore. But as it rolls, it builds momentum. And eventually, it becomes something much bigger than the effort you put in. Here's the irony. The hardest part of lazy investing is not doing anything, because everything around you tells you to act. News headlines, market swings, other people's success stories. It creates this constant pressure to react. But reacting is often what hurts you. Staying still when everything feels uncertain, that's the real skill. And yeah, it takes discipline. Not effort in the traditional sense, but emotional discipline, which is arguably harder. So what does this actually look like in real life? It's simple. You pick a broad market fund. You invest regularly. You don't try to time it. You don't panic when things drop. You don't get greedy when things rise. You just stay consistent, month after month, year after year. And over time, that consistency becomes your advantage. At the end of the day, the lazy investor strategy isn't really about being lazy. It's about being honest about what you can control and what you can't. You can't control the market. You can't predict the next big winner. You can't avoid volatility, but you can control your behavior. You can control your consistency. You can control whether you stick with a plan or abandon. At the moment, things get uncomfortable. And honestly, that's where most of the results come from. Not brilliance, not perfect timing, just staying the course. And I know that's not the most exciting message. It's not flashy. It doesn't make for dramatic stories, but it works quietly, reliably, over time. And maybe that's the real shift. Here, realizing that building wealth doesn't have to be intense or complicated or stressful. It can be simple, steady, almost boring, but in a good way. The kind of boring that builds something meaningful in the background while you live your life. So if you've been feeling stuck, overwhelmed, or like you're somehow falling behind, maybe the answer isn't to do more. Maybe it's to do less, but do it better. And then just give it time. Because here's something people don't say enough. The real benefit of this approach isn't just financial. You're not constantly checking your phone, not riding emotional highs and lows every week, not tying your self-worth to a number on a screen. There's a kind of quiet freedom in that. You get your time back, your attention back, and honestly, that might be just as valuable as the money itself. And over the years, something else starts to happen, almost without you noticing. You stop seeing money as this stressful, urgent problem to solve, and it becomes more like a system that's just running in the background, like electricity. It's there, it's working, and you don't have to think about it every second. That shift alone can change how you make decisions in the rest of your life. You start playing a different game entirely. Instead of chasing quick wins, you start valuing stability. Instead of reacting, you start trusting your process. And yeah, there will still be moments of doubt, market drops, scary headlines. That one friend who claims they doubled their money overnight, but those moments don't control you anymore. They just pass through. So maybe the goal isn't to become some ultra-smart, hyperactive investor who's always one step ahead of the market. Maybe the goal is simpler than that. To build something steady, to protect your peace, to let time and consistency do what they've always done, and just quietly, patiently turn small actions into something much bigger than they seem today.